Hi, this is Andy Filipiak in Toronto for the week of November the 7th. Well, there's a lot going on in the markets currently. Specifically, we had the U.S. election earlier this week where we saw, in all likelihood, a shift in the U.S. House of Representatives to the Republicans. The Senate's still up for grabs, so it's hard to say what this will do going forward, but no matter what, the U.S. Is still a divided country. This morning we saw some weaker CPI numbers. The inflation number came in at 0.4% up month over month. It was expected at 0.6%. So this has got the markets ripping on the belief that the Fed will not have to raise rates as much or as long as believed. So we're seeing a bit of a rally in the markets. More importantly, I've included two articles this morning that I think highlight where we're going economically. Specifically, FTX, one of the darling stocks of the crypto world, I believe it was a crypto platform, is in the throes of bankruptcy. It appears that there may be fraud involved. While I'm not an expert on crypto, this was an exchange that if you deposited your cryptocurrencies there, you were able to receive interest on the currency. Nobody really understood how this worked. There was some sort of black box, but it appears that it was driven by people being paid interest on money coming in from new investors, a typical Ponzi scheme. It's still early, but the crypto market has been crushed. Bitcoin and many of the other currencies are hitting lows. This was an industry that was worth about $3 billion. I think we're below $1 billion now, and water is being drained from the tub. The article I've included is quite interesting. Unfortunately, a lot of the times in these manias, legitimate investors get caught up. Specifically, the Ontario Teachers Pension Plan had $400 million invested in this FTX, and it's doubtful that they will get much of any of that back. Hard to believe that sophisticated investors can get caught up in this, but when a bubble or a newfound technology takes off, there's this some sort of psychological need to participate, otherwise you look like a dummy compared to your competitors. The second article is about Romspen, a Toronto-based mortgage lender with $2.8 billion in it. They recently announced that they're closing off their funds to redemptions. They've had several, I think, larger borrowers that are not able to pay the interest on the loans. Now, Romspen's involved in the real estate construction loan business, but the fact that liquidity has been prevented here may just be an early sign of what we're going to see. Quite often, I love the phrase, when the tide goes out, you see who's swimming naked. And unfortunately, for a lot of business ideas over the last decade, 0% interest rates helped drive asset values and help support asset prices and stocks. Now with credit having gone up, the cost of credit gone up so much this year, as I've mentioned in the past, the 2-year U.S. Treasury's gone up 4% this year alone. Businesses are being squeezed. And I think in Romspen's case, and it's a completely legitimate investment, their clientele is really struggling under the new borrowing regime that we're seeing with these higher rates. So have a look at the two articles, and thank you for watching.